Welcome to Stress-Free Investing Analysis, Personal Notes. Today, we're taking a deep dive into an absolute powerhouse in the Indian infrastructure and industrial space, KEI Industries. We're going to strip away all that market noise and look directly at the fundamentals, the financials, and the real, on-the-ground catalysts to see if this company actually deserves a spot on your radar.
Now, just a quick reminder before we really get going, I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks, The data and charts we'll be looking at today are based entirely on public information and my own personal research notes. So please, don't treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, with that crucial context in place, let's look at our roadmap. Okay, let's dive into this. First, understanding KEI Industries. Second, financials and growth drivers. Third, competitive moat and tailwinds. Fourth, red flags and risks. And finally, valuation and final verdict.
All right, Section 1, Understanding KEI Industries. So KE definitely isn't some new kid on the block. They're actually a 56-year-old founder-led company, and right now they sit as India's third largest wires and cables manufacturer. They just posted a massive 11,748 crore rupees in revenue for FY26. But you know what's really exciting? The total addressable market, or TAM. The Indian cables and wires market is expected to hit a staggering 1.25 lakh crores by FY28. To put that into perspective, right now, KEI only captures about 13% of their addressable market. That means there's just substantial headroom for them to keep running and growing. And this brilliantly illustrates a major shift for them. Historically, KEI was heavily tilted toward institutional clients. Think utilities, large EPC projects. Those bring in high volume, sure, but much lower margins, hovering around 9%. But look at FY26. Retail has actually overtaken institutional, sitting at 54%. Retail operates through over 2,000 dealers and brings in roughly 11% EBITDA, or operating margins. This intentional shift toward retail, it's acting as a massive structural tailwind for their overall profitability. It's a real game changer. Now, I want you to remember this number, 5,500 crore rupees. That represents the massive incremental revenue potential they have by FY28. You might be wondering, where exactly is that coming from? Well, KEI is building a massive 2,000 crore rupee greenfield plant, meaning built entirely from scratch over in Sanand. This isn't just some minor expansion, it is literally a foundational growth engine that's going to drastically increase their capacity over the next few years. Moving right along to Section 2, Financials and Growth Drivers. Now, what's really interesting about this slide is the sheer consistency. I mean, you're seeing a flawless, uninterrupted streak of revenue growth over 10 years, literally zero cyclical dips in a decade. Over the last 10 years, they've compounded revenue at 19.2% and profit after tax at a staggering 30.7%. Honestly, that is the textbook definition of a compounding wealth creator. And get this, they're doing all of this without leveraging the company to the hilt. In fact, KEI has effectively zero debt. Following a highly successful qualified institutional placement, or QIP, they're sitting on roughly 1,737 crores of net cash. They have an absolute fortress of a balance sheet. What does this mean for us? It means they can fully fund that massive Sanand expansion without taking on any equity or debt risk through FY28. Pretty incredible, right? However, we do have to look at the full picture here. In FY25, cash flow from operations, or CFO, dipped into negative territory at minus 32 crores. Now, is this a panic moment? Absolutely not. The data shows this is entirely due to a deliberate, massive working capital and CapEx build for that Sanand plant. To prove they aren't in distress, just look at their Altman Z-score. It's 12.6. Anything above 3 is considered the safe zone, so they are in a highly intentional, fully funded growth phase, not a cash crunch. Which brings us to Section 3, Competitive Moat and Tailwinds. Let's move to CAN-C and see how this builds their true defensive moat. The cable market is basically split. On one side, you have low tension, or LT cables. This is kind of a commodity space, with intense competition from giants like Polycab. But on the other side, you have extra high voltage, or EHV cables. This is KZ's castle. Thanks to a technical collaboration with a Swiss company called Brugg Cable, KEI can manufacture 400 kilovolt plus cables. This segment has massive 4 to 8 year entry barriers, huge capex requirements, and there are only 2 or 3 qualified suppliers in all of India. It's a true oligopoly.
And the demand for these high-end cables, it's accelerating rapidly due to some incredible structural drivers. We're talking renewables integration, a real estate revival, and massive government infrastructure pushes like PM Gati Shakti. But here's a truly surprising fact. Every single hyperscale data center being built right now for AI and cloud computing requires 5 to 10 times more extra high-voltage cable than a conventional building. That is a massive, brand new secular growth driver that literally wasn't even in analyst models just a few years ago.
All right, let's keep it objective. Section 4, red flags and risks.
So, here is our proprietary red flags scorecard. The good news, we're seeing 0 hard red flags. No earnings manipulation, no promoter pledging, clean governance. Love to see it. But there are several crucial watches we need to keep an eye on. The biggest one is execution risk. The EHV phase of the Sanand plant has been delayed to Q4 FY27. We are also watching intense competition from Polycab, volatile copper prices on the London Metal Exchange, and of course, that negative FY25 cash flow we discussed earlier. So the crucial point is this. As an investor, you absolutely need strict falsification metrics. If KEI posts a negative cash flow from operations for a second consecutive year in FY26, well, the narrative stops being about an intentional CapEx build and changes from a watch to a hard flag. It requires strict discipline from us to monitor this closely. And finally, Section 5, valuation and final verdict. Let's break down the pricing over a 3 to 5 year horizon. Right now, KEI trades at a trailing price to earnings or PE ratio of roughly 52 times. Simply put, that is expensive. The market is basically pricing in near perfection for their future cash flows. In our base case, assuming 20% growth and successful Sanand execution, we see a target of 6,800 rupees. That's a solid 34% upside. But in a bear case with further delays and margin pressure, it could drop 24% to around 3,850. Because the current price offers a pretty limited margin of safety, optimal entry logic dictates waiting for a dip below 5,000 rupees to really improve your risk-reward ratio. Bringing all these dimensions together, the financial health, the moat, growth, risks, and of course valuation, we land at a final score of 79 out of 100. This earns KEI Industries a grade B, accumulate rating. Make no mistake, it is an exceptionally high-quality compounder with a phenomenal runway ahead of it. But it's currently held back from an A grade purely by its demanding valuation and those execution risks tied to the Sanand facility timeline. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a CBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.